A 100 megawatt facility outside Abilene, Texas sat finished by early 2026. Racks in, GPUs plugged in, cooling loop pressurized, and tested. The only thing missing was a signature from the local utility saying it was allowed to draw full power. For 7 months, that building burned through interest payments and lease costs while producing almost nothing. Tens of millions of dollars in hardware sat as useful as a parked car with no keys. Every day of that wait had a real cost attached to it, and nobody paying that cost could do a single thing to speed it up. Quick housekeeping before we get into it. If you've watched this channel before, you know we go past the press release and into the actual numbers. If that's your thing, the subscribe button is right there, and it genuinely helps this channel keep making these. Here's what makes this industry strange. Every headline says, demand is infinite. Capacity is sold out before it's built. Backlogs are counted in the hundreds of billions, and yet inside the companies actually building this stuff, something keeps happening that shouldn't happen. Revenue doubles, losses widen. A business that looks like it's printing money on the top line somehow bleeds cash by the time you get to the bottom. So here's the real question. If demand is this strong and pricing power is this real, how does a company selling 100% of what it builds still lose money doing it? To answer that, stop picturing a data center as a warehouse full of computers. Picture it as a wager, financed almost entirely with other people's money, on exactly how long a piece of silicon stays worth something. Start with what's actually being sold. A customer, usually an AI lab or a hyperscaler buying overflow capacity, isn't renting square footage. They're renting scarcity. They sign on for guaranteed access to a cluster of chips, sometimes for one project, sometimes for years. That contract becomes the single most valuable thing the operator owns. More valuable in a lot of cases than the building itself, because it's the thing a bank will actually lend against. CoreWeave, one of the biggest names doing this, posted $2.58 billion in revenue for the second quarter of 2026. That's growth of 112% from the year before. Its backlog of signed customer commitments hit $104 billion. On paper, that's about as strong a demand signal as a company can produce, but a backlog isn't cash sitting in an account. It's a promise stretched out over roughly 4 to 5 years that has to be converted into delivered, powered, running compute before a dollar of it actually shows up as revenue. That conversion from promise to delivered capacity is where this business actually lives or dies. Follow the money the way it really moves. The customer pays for GPU hours or for a reserved block of dedicated capacity. That becomes revenue once the compute is up and running. Then it survives a lineup of claims. Electricity and cooling get paid first, and on a large site, that alone can run past $600,000 per megawatt every year. Staffing, security, and networking come next. Then, depreciation, the accounting charge for wearing out the chips and the equipment around them. Then, interest on the debt that paid for all of it in the first place. Whatever's left after that lineup belongs to the owner. CoreWeave's gross margin, before most of those costs hit, looked excellent in early 2026, sitting above 70%. That's the number that ends up in the press release. But gross margin isn't the whole picture, and what happens after it is where the contradiction actually lives. Between the first quarter of 2025 and the first quarter of 2026, the company's adjusted operating margin fell from 17% down to as low as 1%. Revenue nearly doubled in that same stretch. Read that twice, because it's the strangest fact in this entire industry. The company sold more, it grew faster, and the share of that revenue turning into actual operating profit almost disappeared. Here's why. When a new facility comes online, its costs start on day one. The lease payment starts, the power bill starts, the depreciation clock starts ticking the moment the chips get switched on. Revenue doesn't start at full strength that same day. Customers ramp their usage in stages, sometimes over many months, as contracts activate on their own schedules. So, for a while, a newly built facility is fully costed and only partially earning. Build enough of those fast enough, and you can grow revenue explosively while watching your margins get crushed by an army of half-ramped assets that all cost full price to run every single day, whether they're earning or not. That's a company outrunning its own cash flow. And the debt behind that expansion has a gravity all its own. CoreWeave's total debt reached $35.6 billion by the middle of 2026. Quarterly interest expense alone hit $640 million, up 140% from a year before. Interest doesn't care whether a facility is fully ramped or sitting half empty. It's due every quarter, on schedule, regardless of what the chips inside that building happen to be earning that month. Some of that debt is secured directly against the GPUs, the same way a mortgage is secured against a house. CoreWeave's $8.5 billion facility, rated investment grade, treats a rack of NVIDIA chips as durable collateral, priced near 6%. Other slices of debt are far riskier, carrying coupons above 9%, which is the market's honest opinion that this isn't quite as safe as a mortgage. That comparison, GPUs treated like real estate, is exactly where this stops being a financing story and starts being a story about a clock. A commercial building can sit productively for 30 years. Its value declines slowly, if at all, and a bank pricing a 30-year loan against it is standing on reasonably solid ground. A GPU is nothing like that. NVIDIA redesigns its architecture on close to a yearly cycle. What's cutting edge in one generation is meaningfully behind within 2 or 3 years, even if the chip still works fine. Most hyperscalers depreciate their GPUs over 4 to 6 years for accounting purposes. Michael Burry, the investor best known for calling the 2008 housing collapse, argues that number is closer to fiction. His estimate is that the industry is understating depreciation by roughly $176 billion between 2026 and 2028 by assuming these chips last far longer, economically, than they actually do. NVIDIA and CoreWeave both dispute his framing directly, and it's only fair to say this is a live argument between credible people right now, not a settled fact. But here's a data point that's harder to argue with. An H100 chip that sold new for around $40,000 in late 2023 was changing hands on the used market for as little as $6,000 by mid-2026. That's one transaction, not a proven industry average. But it points in a direction. If the chips backing tens of billions of dollars in loans are losing value that fast, the collateral underneath this whole financing structure is shrinking faster than the loans against it are getting paid down. Follow that thread far enough and you land on something quiet but serious. Not a dramatic blowup, but a covenant. Many of these asset-backed loans include terms that trip if collateral value falls below a set threshold relative to the debt outstanding. If used GPU prices keep sliding anywhere near the pace we've already seen, some analysts think those covenants could start tripping as early as 2027. When that happens, refinancing doesn't happen on the original terms. It happens on whatever terms a nervous lender is willing to offer, or it doesn't happen at all. If this is the first video of ours you've come across, drop a comment with the industry you'd want us to open up next. We read every one, and half of what we've made started as a suggestion down there. Something close to this covenant scenario already played out, just without the trigger actually firing. In June of 2025, CoreWeave's stock traded near $187 a share. Short seller Jim Chanos started picking apart the math in public, arguing that even under a generous 10-year GPU lifespan assumption, the company's annualized earnings looked thin against roughly $1.2 billion a year in interest on an estimated $20 billion of GPU assets. Burry's broader depreciation critique landed around the same time, and investors who'd been comfortable treating GPU collateral like real estate suddenly weren't. By mid-December of 2025, the stock had fallen to roughly $72. That's a 61% collapse in 6 months, wiping out about $33 billion in market value. No default happened. No customer walked. No facility went dark. What changed was confidence in an assumption, the assumption that this collateral holds value the way a building does. Once credible outsiders started pulling that assumption apart in public, the market repriced it violently, on its own, without a single thing actually breaking on the ground. That's the risk sitting underneath every headline about sold-out capacity and record backlogs. The vulnerability isn't a bad decision anyone made. It's built into the model itself. Now rewind further to a business that went all the way through this cycle to its actual end. In December of 2022, Core Scientific filed for Chapter 11. It wasn't an AI company. It ran large data centers for Bitcoin mining, but the skeleton underneath it, specialized hardware, heavy power draw, and debt sized to a revenue assumption, is close enough to matter here. Core Scientific had gone public through a SPAC deal valued at $4.3 billion, built facilities across 5 states, and financed the build-out with debt serviced by mining revenue. That worked fine while Bitcoin traded near $70,000 in late 2021. It stopped working when Bitcoin fell to around $16,000 by November of 2022, while the electricity needed to mine each coin kept climbing, and one of the company's own customers, Celsius Networks, collapsed into its own bankruptcy, owing money it would never pay back. Electricity costs alone ran past $100 million in just the first half of 2022. Revenue, denominated in a collapsing asset, fell. Costs, mostly fixed, did not. The company reported a quarterly net loss of $434.8 million. Market value fell from $4.3 billion to roughly $78 million, a drop of more than 98%, in about a year. Nothing about the physical infrastructure failed. The buildings still stood. The power contracts still existed. What failed was the assumption underneath the financing that revenue would keep pace with fixed obligations. Once that assumption broke, there was no slack left anywhere in the balance sheet to absorb it. There's a lesson sitting in both of these stories, the stock collapse and the bankruptcy. And it isn't really about GPUs or Bitcoin specifically, it's that infrastructure economics look unbeatable right up until the revenue assumption underneath them turns out to be wrong, and by the time that's visible, the debt has already been spent. Even that isn't the deepest constraint on this industry, though. Chips get almost all the attention, power gets almost none, and power is genuinely the harder problem. Between the year 2000 and 2019, roughly 77% of proposed grid interconnection projects in the United States were eventually withdrawn before ever reaching commercial operation. The wait to get a large new project connected to the grid now averages around 5 years. Physical construction of a data center typically takes 18 to 30 months. So the wait for permission to plug in can run 3 to 4 times longer than the time it takes to actually build the thing waiting to be plugged in. A company can raise unlimited capital. It can secure every chip NVIDIA is willing to sell it. And it can still watch a fully built, fully paid for facility sit dark for the better part of a year, waiting on a transformer, a substation upgrade, or a utility's permission to draw as much power as a mid-sized city from a grid that was never designed for one industrial customer pulling that much electricity in one place. That scarcity has its own price tag now, too. PJM, the grid operator covering a wide stretch of the eastern United States, cleared its most recent capacity auction at a record $329.17 per megawatt day in 2026, pushing the total cost of that auction to $16.1 billion, up from $2.2 billion the year before. Data center demand is now measurably raising electricity costs for households that have nothing to do with AI at all. So, if the chip isn't the real bottleneck and the building isn't the real bottleneck, who actually keeps the money in this system? Follow the chain all the way to the top, and the answer isn't the company with its name on the building. NVIDIA sells the chip and increasingly finances the customer buying it too. The company has organized roughly $500 billion in third-party financing arrangements with major private equity and banking partners to fund AI infrastructure broadly, and separately agreed to backstop up to $105 billion behind a single OpenAI campus in Ohio. NVIDIA collects revenue on the sale, equity upside in the customers it backs, and fee income on the financing it arranges. A reported profit margin near 75% tells you most of what you need to know about where the leverage actually sits in this industry. Then there's the landlord. Equinix isn't chasing the cheapest GPU hour on the market. It runs more than 260 carrier-neutral facilities where the value comes from density, from networks and cloud providers and enterprises, all paying a premium to be physically close together, connected through cross-connects that get more valuable with every tenant that joins. Equinix's underlying assets, buildings, power systems, fiber, depreciate on real estate timescales, decades rather than years, while its tenants carry the risk of whatever equipment they choose to install. The result is an adjusted earnings margin near 51% and 11 straight years of rising dividends, built inside the exact same boom that's simultaneously handing steep losses to the operators actually running the compute. The NeoCloud operator, the CoreWeave model, sits in the shakiest spot of the three. Highest revenue growth in the industry, deepest exposure to depreciation, refinancing, and customer concentration risk, and currently unprofitable on a GAAP basis despite a backlog that would make almost any other industry jealous. Below all of that sit the people who never signed a single contract in this story. Households sharing a power grid with facilities pulling as much electricity as an entire city, watching their utility bills climb in constrained regions without capturing a single dollar of the revenue those facilities generate. That's the real shape of this industry. Not a straight line from investment to profit, but a chain of claims, each one paid before the next, with the operator running the most visible, most talked about piece of the infrastructure, absorbing whatever risk nobody upstream was willing to hold. Which brings this back to that dark building outside Abilene, fully built and fully financed, waiting on a signature. Picture how a competent, well-run operator could still end up in serious trouble without making a single bad decision along the way. GPU rental pricing softens, maybe because a major customer pulls back, which already has precedent. Revenue growth slows while debt service and depreciation keep running on schedule, untouched by any of it. Refinancing gets harder, not because anyone mismanaged anything, but because the GPU collateral backing the loans has quietly lost value faster than the loan itself has been paid down. Covenants that looked comfortable on day one start looking uncomfortably close. Without a surge in customer demand or an outside rescue, something like a vendor guarantee from NVIDIA, the company ends up walking a path close to what Core Scientific walked, not because of one mistake, but because of a mismatch between a fixed financing schedule and a fast depreciating asset sitting underneath it. None of this means the industry is smoke and mirrors. The demand is real. The revenue is real. NVIDIA's chips genuinely are scarce, and the contracts genuinely are backlogged years out. This isn't a story about fraud, or a bubble waiting on cue to pop. It's a story about mismatched clocks, a grid connection that takes 5 years, a loan that runs 7 to 10, a chip that stays competitive for 2 or 3, a building that could stand for 30. Every dollar of profit this industry reports right now depends on which of those clocks you believe. Assume the GPU behaves like a building, slow to lose value, durable, and the balance sheets look manageable, even attractive. Assume it behaves like what it actually is, a piece of technology its own maker redesigns almost every year, and a meaningful share of today's reported profit hasn't actually been earned yet. It's a bet on a depreciation schedule that hasn't survived a full cycle, so the owner's real return in this business was never just revenue multiplied by price. It's contracted revenue times how much of that capacity actually gets used, minus power and facility costs, minus depreciation calculated against the true competitive life of the hardware rather than the accounting life sitting on the books, minus the interest owed no matter what, minus whatever capacity is stranded, earning nothing, waiting on a grid that was never built to carry this kind of load. The chip company gets paid on delivery. The landlord gets paid on a lease. The lender gets paid on a fixed schedule. Everyone downstream of the operator gets their claim settled before the operator sees a residual dollar, and the operator is the one holding the asset, losing value the fastest out of anyone at the table. That's what it actually means to own an AI data center right now. Not a toll road collecting rent on scarce compute. A leveraged bet that the clock on a chip's usefulness runs slower than the clock on the debt that paid for it. Made by companies that won't know for certain which clock was right until the loans start coming due. If this changed how you see the AI build-out, share it with someone who's still convinced this is a straightforward gold rush. And if you want the next one the moment it's up, you know where the subscribe button is.